Hey, option traders, Justin Nielsen here. For today's strategy, we're going to be looking at an income play to increase the yield using Microsoft. Now, the way we're going to do that is with a covered call strategy. So why would you do this? Well, with the low interest rate environment that we've had, a lot of the dividend players haven't been getting much income. If you're used to getting that, it just hasn't been there in the current market. In fact, if you use the S&P 500 and look at the yield, it's only 1.3%. That's not much. Now let's talk about an alternative way to get some yield using a covered call strategy. It starts with a solid company that you wouldn't mind owning anyway. And for every 100 shares you have, you're going to sell one call option contract, and you're going to collect the premium on that as income. That's going to be yours to keep. It's almost like you are owning a house and renting it out to get some income from it. So what's the catch? You do limit the upside potential for the stock. So let's take a look at how this would play out with Microsoft. The ticker symbol on that is MSFT. Microsoft has long been a bellwether stock, and its market cap is now above $2 trillion. That's been a driving force behind recent market strength. Microsoft is on the IBD long-term leaders list, it's a member of Leaderboard, and it's ranked number 2 in the computer software desktop group. It's got a stellar composite rating of 98. When trading covered calls, most investors like to sell monthly calls. This makes sense because it makes the most out of the time decay that happens as you get closer to expiration. It puts downward pressure on the option premium, which, as a seller, you want that premium to go down. But this also takes a more active management style. Let's take a look at how we could do this with yearly covered calls. So we're on my Thinkorswim trading dashboard, and the first thing I'm going to do is type in Microsoft. MSFT is the symbol. I'm going to go down and I'm going to choose the June 22 expiration because remember, we're looking at a yearly contract in this case. I'm going to look at the options contracts available and I'm going to scroll down to the 290 strike price. The calls are on the left, the puts are on the right. And in this case, we want to be selling a call. So I'm going to go to the strategy and say covered stock. And in this case, it shows that I'm going to sell and I'm going to go ahead and make this adjustment to just sell one contract. And you can see that it's going to buy 100 shares of Microsoft. Now, you might be wondering, you see this price here, 262.17. So wait a minute, Microsoft is trading at 286.24. Why the difference? Well, you get to receive that premium of 23.90. So in effect, you're kind of buying the stock for a cheaper price. And there you have it, your option trade of the week. Remember, options are risky, and investors can lose 100% or more of their initial investment. So make sure that you practice with a virtual account before risking real money if this is new to you. You can also check out investors.com/options for more options trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.